All right, welcome back. And the fun has started. I wanted to talk about what just happened on Friday, basically. Um, First off, if you don't know who I am, I'm Ben Collins, I'm CFA charter holder and Chief Investment Officer at Options Autopilot, an automated options trading platform. If you want more info, there is information in the description. I wanted to go over the markets in general, also how my automated trades are set up and how they're doing currently, and also why we should be cautious, but I'm actually pretty interested to see how this plays out because I'm kind of positioned well, and this is sort of why the automation is set up to succeed in the long term. So I really want to see this proven out, and I'll go over how I'm currently positioned and what I'm kind of looking for moving forward this week and then kind of beyond. I think everyone saw what happened here. Kind of jump into the screen. This is SPX. Trump came out, said they're increasing tariffs on China. Um, Again, it's, I'm only reading headlines, so I don't really know exactly. But if you read China's response, it does seem like they're kind of the adults in the room and how they're responding to these things. But in general, kind of an unexpected scenario. Obviously, the markets did not plan on this. This could be, I don't want to, say it will for sure, but these kind of unexpected shocks can be the straw that broke the camel's back. And kind of, valuations were stretched. It gives people a reason to reduce risk and kind of sell into the end of the year. We can kind of see a pretty big down move here. And, if you didn't know any better, this would probably be considered a top. That happened in a day. This is why we have to be cautious on volatility strategies and just strategies in general, because I think the market moves more like this these days, just because a lot of people are using volatility. And I kind of want to go over how the 111 reacted in this scenario, and actually how like a theoretical one would have, because I actually did a webinar, we got a link in the description, on Thursday, and kind of put a theoretical one on, and I wanted to show both how the margin moved, because I think a lot of people don't understand that dynamic and how it can go against you. But also, I'm not trying to like freak people out. This is actually good to go through because you kind of know worst case scenarios, and it's like you're experiencing how it would happen if for some reason you're going to lose money or however it goes. And you just need to be more comfortable and therefore position size correctly for like withstanding these drawdowns or how they happen. So that's kind of the purpose of education here. So if you like that and you appreciate the transparency, please subscribe, share with someone who could benefit from this. And let's kind of just go through that. So I would say, again, if we don't get more clarity today, it's Sunday, which it doesn't seem like we are, I do feel like we might get more of a sell-off, or maybe we'll have a little bounce in the morning and then people will continue to sell. Again, just to reduce risk, valuations are kind of stretched on some companies. So it did kind of set the tone for more of a risk-off scenario. So you can kind of see this big move down in the S&P. We can see the VIX spiking massively. Again, I've talked about this in the past that these types of moves are more common these days. It can sit down here and be fairly low vol, but then all of a sudden you get a 16 to 22 spike. So you get a 6-point move in the VIX, and that's huge, right, from a percentage basis. And if you're not positioned and you're very short Vega, then that can hurt you. If anyone's been following along, I've actually been leaning short on these ESs, and they've been hurting me for the most part. This is a little messed up. I think it's because the futures bid-ask spreads kind of widened out, and now they're somewhat closing down, so it looks like a profit. I don't know if it actually is, because at the end of the day, they also widened out, so it looked like a loss sometimes when it isn't. But in general, I was leaning short on my ES 111s because I had done this call side, and obviously I was complaining about it the whole time because the market just was relentlessly moving up, and it was hurting me. And it wasn't one of my automations, so I should have just kept it on. But now we can kind of see it was helpful, or at least it helped on Friday, where it wasn't really down. and it pulls, the pullback basically makes it where I could earn a pretty decent credit if we kind of sit around here for the next, month or so. Who knows what's going to happen? Um, but you can kind of see I was actually leaning about 100 at a certain point, like 120 delta short, um, and now it's 12 long. So that's totally shifted. Obviously, it's pulled back very quickly, and so that made the gamma adjust, and now I'm basically long via this position because it's pulled back from these strikes so much. So that's how that can work. That was kind of what I was hoping for, but not necessarily such a quick move in that scenario, right? The MES, this is where I switched to doing more frequent 111s. This is going to be very interesting because you can see that in the money, I have a lot of these converting to hedge. So right here, if it hits so as an example, our automated platform, basically you put on the 111, if it gets to your profit target, it'll just close down the short put, the far of the money short put, and then it keeps on the put spread, right? So that's technically a hedge. So it's done that a couple times, and now you can see this hedge that's on is actually in the money. So if it actually finishes here, I have the ability to earn a decent, return potential right there. I guess I'd have to do the math, but like 66.50 to 65.75. If it basically expands by expiration, this should actually give me quite a bit of capital return potential. And that's kind of the point, right? It ends up making up for some of the losses that happen in these scenarios. So here's another one. This only has one of the strikes in the money at this point. But again, I'm not going to touch them because I just want them to be the hedge and let it go. Because if the market keeps pulling back, that's the point of them. Because I'll probably be getting stopped out on other positions. And if I am, then the whole idea and the benefit of the one-on-one where you can potentially, earn money on the bear trap area, is that it ends up finishing, in the bear trap, or in this instance, it's just the put spread protective one. So that's kind of what I'm watching here and why I'm a little, not excited is the wrong word, but interested to see how that goes in general, because that's, again, the whole point of the automation. It just did that automatically. I didn't do that. Those were obviously already sitting there as a hedge, weren't making money. We're probably just losing money. And then these scenarios are where it can be helpful. I had another hedge on. I think it was going to expire in 7 days, and it had jumped up. I mean, again, MES is much smaller, so it was up like $35. But in general, I think I made probably $35 on the spread when it closed. So it basically like doubled my money. So I basically closed one of those down. Just because it had such a little timed expiration. If it would have rebounded, it would have completely gone to zero. So I was like, it's not going to protect me as much. So I closed that down. Interestingly enough, what else do I want to show here? Before I wanted to jump into an actual Thinkorswim risk graph to show how margin moves. And this is what I try and explain in general about this strategy. And a lot of people didn't understand the last one move, but you can see the bond 111s weren't necessarily working, then all of a sudden they were, because obviously bonds spiked, right? That's again the reason I'm doing this across asset classes, to get a little bit of diversification. I might increase my bond 111 exposure to get closer to countering my S&P, almost like a 50-50 portfolio, just because I think we might be entering a scenario of an uptrend in bonds, and I wouldn't take this as confirmation because it's just a reaction at this point. But if there's follow through, then it could be the signal that the market's moving in a more defensive manner. Crude oil has been not working this year because it has so much volatility, it seems like. So I was up actually on the crude oil for a while, and then all of a sudden we get these kind of moves, and then we'll get a big down move and I get stopped out, or I go from profit to loss. So again, in the long run, it should work out, but this is not necessarily positive for anyone who's long oil. So that's just how that's going at the moment. Bitcoin has been working, but hit a new high recently, and now it's definitely it's being treated as a risky asset, right? It's not a safe haven. People are not flocking to Bitcoin as a safe haven for when markets are volatile, right? They're viewing it as a liquidity source and probably just a position. So was making a new high, broke back down, right? So I don't know. I still think the trend long term is up, but if people need liquidity, they might be going to Bitcoin for that. Let's go to GLD because I've been totally wrong on gold this entire time. Not that I was making a position bet. It was more of like I was just thinking it was up so much. I was like, how can it keep going? But this is the example where you just need to trust automation and just let it go because it's now made a brand new high and only slightly pulled back here. So that's been interesting. And someone I think did a post the other day that I follow that they're like, oh, is gold as a risk off trade broken? And they're like, not necessarily. Like maybe this is technically risk off, right? Maybe this is kind of a shift in new world kind of thinking of gold, Bitcoin versus dollar in the U.S. So who knows? But that's been an interesting kind of scenario. The other thing I wanted to mention was XRP that had some crazy volatility. Around this, right? So again, it's kind of highlighting the fact that maybe it's not really a safe haven asset. And there it looks like they must have been an error in this trade, but there was a trade that went all the way down to like 190 I saw at the time. So I don't know if that was just an error. They must have cleaned that up and corrected it, but pulled back significantly. I haven't added because obviously if you've been following, I've been waiting for it to finish above this line, and I drew this a long time ago. It still hasn't. It looked like it was going to a couple times, and then it finally looked like it was going to end of last week, and then this stuff happened. So still doesn't seem to be like an asset that people are wanting to own at the moment. So I'm not going to add to it for now. So let's go over my SOFI. This stuff's again annoyingly kind of skewed because of bid-ask spreads widening out. So obviously I'm not going to say up on Intel. I would highlight that it's been kind of annoying because I've shifted my position to just the call spread, and I basically am not making money with it going up, or at the time it was going up, right? And that's because the skew was so heavy to like the farther out of the money calls, like they were gaining more value than even the nearer term, which is not how it's supposed to be. But that's how it can happen when people are kind of leaning one way. RIVN, I might have to cut this position fully. I had already reduced it because it had broken down here. It's still, I don't know why TastyTrade, the lines continuously get messed up for some reason, but I would say it's still holding this trend line. If it breaks this trend line, I will exit. So I would say if it breaks 1250, we're probably going to be fully out of there. Conversely, I guess if it goes back above this line, I would add back. I only reduced it by 4 contracts. I still have 10 contracts. So again, the other one is SOFI, which again, it was annoying because SOFI was working very well going into the day on Friday. It literally was at $29 earlier in the day, fully reversed, and then dropped 26, right? So this is just what can happen in the markets. I guess coincidentally it did run in this line, which I had previously drawn. But that's just a massive move. That's kind of unfortunate. Doesn't help me feel good about going into earnings now. I was kind of hoping we had a little more cushion here. And I was going to maybe lighten up my short puts on there and move them down farther at least. Like my closest one is 23. I was going to maybe close these down. So I was going to be up a little bit and then move it down farther out of the money to either 22 or 21 probably, just for earnings. Because I'm fine buying it lower if I get assigned. It's just more of, I was hoping to just pull in the premium, right? But this is just how it goes. And why you have to manage your risk and your positions correctly. So let's dive into this. This is the typical 1-1-1 structure. This is what it looks like. This is the one I had kind of created for an example on a Thursday webinar. And this is why it's kind of a benefit, right? If anyone hasn't really seen this, this is, on Options Autopilot, one of our strategies you can just easily automate. But so you can basically be making money as the market's going up from your credit spread, but then obviously if things start to move against you, with automation you just get stopped out, but if it goes slow enough, you have the ability to finish in this bear trap area, it's called, and then you can make, 4 or 5 times the money that you would make on your credit side, because you can see this is 875 on the credit, and then this is 5875. So significant amount more money if it ends up finishing in this bear trap area, and that's why it's kind of a benefit. But if it starts to move against you fast, you either need to be able to manage it or just have the parameters in there for it to stop you out. So as an example, you can see right here, margin requirement right now is 8,373. When I had put this on for the webinar, it was actually below $6,000. It was just below 6,000. I wonder if I can go back in time on this. Probably doesn't think back. No, it doesn't. Okay. So never mind. That is the 12th. So I'd have to use think back to show that. But either way, the point is the same. Is that when you put it on, it was basically around $6,000 in margin. A 2% move in the market and the VIX spike. Now it's at 8,373, right? So still keep this in mind. This is almost 100 days to expiration, 1-1-1. $875 on 8,373, almost still a 10% return, right? It's actually more than a 10% return potential over that time period, which is still very good. But you need to understand that how quickly the margin requirement can move, and that's why you definitely want to manage your risk and make the assumption that if VIX is low and the market's high, like you don't want to be leveraging your account up, right? You don't want to be using 70% of your margin already to do this, or 70% of your capital. You probably want to be 25 to 35% at most, because you can see if it gets all the way down 10%, you're going to be double the requirement, right? And this is where people get into trouble and get forced to liquidate when it might be the worst time to be doing that, and then it makes it hard for you to recover. So we can kind of see this is where the market is now, and right now the market's showing that you would have lost $1,350. That's going to be close, not quite, in terms of my parameters. So you're almost getting stopped out in a day. So worst case scenario, let's say you put this on Thursday, thinking you're going to make this $875. Then the market, this happens. You're not stopped out yet, but you might get stopped out. And so you just need to keep in mind that this can happen depending on when you're starting. So you don't want to start out with like all your money doing this. This is where if you have less than $10,000, I would use MES, not ES futures, because then it just requires like 10 times less than this, right? So you can do more contracts and scale it up versus doing the one, and then if you get stopped out and you lost $2,000 immediately, you don't feel bad. Like that would suck, especially if you're only trading with $10,000. And that's one of the reasons, again, not that I tried to time this, it was more of, that's one of the reasons I switched to MES and wanted to go more frequent but smaller positions in the event that this happened, because that's just the benefit of it in general, right? But again, I wanted to highlight that you just need to know how this is. For options autopilot, like if I would have put this on and if it got down to here, I probably would be getting stopped out. And obviously the market was up here originally. So it's about a 4 to 5% move down, but if it happens quickly, like you want to get stopped out. I know it sucks, but you want to get stopped out, and then it would open another one theoretically when the market is down farther, and likely volatility is higher. So it's like you're kind of giving yourself more cushion each time it redoes a position. But again, this is where you have to know that you're short Vega, and this type of move in the VIX impacts you just as much, or actually more, than the move against you in the market, because it's still pretty delta neutral. You're not very long the market in general. It's the fact that you're short Vega quite a bit, but you just need to know all these things moving together, right? That's where the automation and options autopilot is helpful, anyone using it has obviously benefited from just letting it go, but you need to know, like, when these things go against you, or maybe things that close down, you have to understand why that happens, just so you are more familiar and comfortable as to, it's okay. It's kind of a natural part of the market, but it kind of sucks when it happens all at once. So that is just something I wanted to highlight there. In general, again, this is going to be inaccurate just because of the bid-ask spreads where they were. I think when I last filmed, I was down to 26,000. I think I got back up to about 29,000. So things had started to recover. So I'm technically up from where I was on the last video, but I haven't really done much except for just let the automation put on positions this entire week. And I think that the bid-ask spread is maybe making this look higher than it is. It's probably around 26,000 again, maybe 25, just because those puts, or not the put spreads, the call spreads on SOFI and Intel are probably not pricing correctly at this point. So just keep that in mind. In general, still up quite a bit for the year, and I'm feeling good about where I'm at in terms of the positions and converting them to call spreads versus just straight up calls, because if you recall, keep using call so much, but for SOFI, I mean, it was up to 32. I converted to a call spread. Had I just let it go and kept the calls on, sure, I would have been up a little bit more, but then now I would have given up a lot of this gain for the year had I not done that. Same thing with Intel, a little bit different. I actually would be up more money on Intel had I left just the calls on, but you just never know how this is going to play out. So I wanted to de-risk my position and just let it work for the rest of the year. Let's see if we got this. Wanted to let it just potentially work for the rest of the year if it was going to keep going, and get into my call spread and just let it sit and expand. So maybe, I mean, it looked like it was making a new high until this whole scenario happened. This could be positive actually for Intel. The backdrop's not positive, but again, if all this stuff is happening and it pushes for more domestic production of chips and everything, you could actually get some positive news of people partnering with Intel, right? So that's where it actually could end up being positive. But if this pulls back a little bit more, I might add to my call spread. That would kind of be breaking my rule of not being up on the position, because again, I'm not actually up on the position. This is just skewed from the bid-ask spread being off. I'll show you this, just because I think people need to understand how this can happen. So see how wide it is right here. That's just kind of making it show a profit when it's really not. If I'm up, I'll definitely add. If it basically gets down to $1 for the price of the spread, I might add a little bit more, maybe 20 more contracts, just because that could expand from $1 up to $5 long term, and I'm kind of making the long term play, right? So makes the risk reward a little bit better, and I'm still only going to risk like half of the capital I've made. So that's just how you kind of take money and hopefully can multiply it and reduce your risk over time. But yeah, that's pretty much it. I mean, I'd be cautious, but that's the benefit I think of automation. Is I think this is technically the time to be putting these positions on. Volatility is mean reverting, but I don't think that we're probably out of the woods yet. But you can never know exactly when it's going to happen. So you just kind of got to be consistent. If you don't get any kind of clarification, I do think we could get a spike above this level right here. I drew this a long time ago. It's kind of like average. So if we kind of get a move up to the mid 20s or even 30, if that happened, I would probably be getting stopped out of quite a bit of my 111s. But again, I think that is okay because I'm doing it so frequently and I have those hedges in place that it'll be fine over time, and I'll just keep putting them on while VIX is higher, and then it should mean revert down here. So that's the plan. I guess, stay risk managed. That's always the key to it. Like, subscribe if you appreciate this kind of transparency and realistic scenario. I'm not trying to sell or always making money or whatever it is. It's all about risk management and doing things consistently. That's where the automation is helpful. Check out Options Autopilot and stay tuned for this week. Happy trading, and we'll talk to you then.